In today's video, we're going to be going over the best ICT silver bullet strategy that ICT himself said that there is no better silver bullet strategy than this one. So this strategy actually forms every single day. And just to add, ICT did also say that you can quit your job in 90 days with this strategy alone. So the model that I'm going to be showing you today is highly consistent and also has a very high win rate. However, a ton of people on YouTube have overcomplicated the strategy and not explained it very well. So I'll be simplifying it for you step by step. Okay, so first things first, let's start off with what pairs work the best for this strategy. So I've actually backtested this myself and I've come to the conclusion that this strategy works the best for indices or indexes. So US 100 and US 500, these can be found on a forex broker and are very, very good for this strategy. I tend to actually trade index futures, which is NQ and ES. The price action on there is much cleaner. However, if you're using a forex broker, you can use these two instruments, which are US 100 or US 500. These are pretty much the same pair as the index futures, but you can just use them on a forex broker. Okay, so we have 3 sessions that this strategy can be traded in. The first one is London session silver bullet. This occurs between 3 AM and 4 AM New York time. The second one is the New York AM session silver bullet. This occurs between 10 AM and 11 AM New York time. And lastly, we have the PM session silver bullet, which happens from 2 PM to 3 PM New York time. So now let's go over some examples that I've drawn down here for you guys to make things much easier. And I've tried to simplify it the best way I can, step by step, so you guys understand, okay? So number one, you want to wait for sweep of either buy side liquidity or sell side liquidity. So as you can see on my left here, this is a bearish example, okay? Once we get that liquidity sweep, we're going to anticipate a clear displacement that will leave a fair value gap behind and a market structure shift, and then you enter off the fair value gap and you would target your next drawn liquidity. Now your stop loss would either be the low or the high of the displacement candle, okay? That's the minimum stop placement. However, I do like to put my stops above a swing high or swing low, as that gives the trade much more room to breathe and you have way more chance of not getting stopped out prematurely. Okay, so I've also added a bullish example here to the right. It's pretty much the same thing, just a sweep of sell side, bullish displacement, market structure shift, which is a break above a short-term high in this case, and you have your entry of the bullish fair value gap. Now your drawn liquidity can be anything from session liquidity, so this can be either your London lows or London highs. Another drawn liquidity could be relative equal highs or relative equal lows. These tend to usually act as a magnet in the market. When you see equal highs or equal lows, those levels will not stay like that for a long time, okay? So be sure to mark those out. Another drawn liquidity could be imbalances or inefficiencies either at a discount or in a premium. Okay, so if you have a inefficiency below a sell side liquidity level that's in a discount, this could be a very good drawn liquidity. Okay, and lastly, the minimum framework to validate a trade would be 10 handles for index futures and 15 pips for forex. So this pretty much means you would need to have at least 15 pips or 10 handles in between your take profit level in order for you to even consider that trade. Okay, so now that we've gone over the basics of this strategy, let's hop into the charts and show you some examples. Just a quick reminder, guys, before we get into the video, the live signals room is still available. The prices have now been updated to $30 a month. So congratulations to anyone that secured their spot at $20 a month. So if you guys are actually serious about getting your trading to the next level, I'd highly recommend you click that link in the description and secure your spot for only $30 a month whilst that price is still available. You get access to my exact exits and entries whenever I get into a live trade. So that includes my stop loss, take profit levels, full transparency. But yeah, the value inside this group is absolutely crazy. We only took 2 losses this week, netting over 85 handles profit, which is roughly around 300 ticks. So we're closing out yet another week in profit, guys. But yeah, we are absolutely smashing it inside the live signals room. The members inside of there are making consistent profits every single week. So yeah, make sure to get in there. And remember, also my entirely free Telegram group is also in the description. And this is where I actually post my daily analysis, chart markups. There's a lot of free value in this free Telegram group. As you can see, I post some trade breakdowns in there as well. But yeah, there's a ton of value in here, guys, all for free. So make sure to get in there if you're not already. Anyways, let's get back to the video. Okay, so let's start off with the London session example. So the first thing you're going to want to do is mark out your sell side and buy side liquidity levels. So these are your obvious swing lows, your obvious swing highs. Okay, so once you've done that, you want to wait for the macro time to start. So this is from 3 a.m. to 4 a.m. Now that you've marked everything out, you want to wait for a liquidity sweep. So this can either be buy side or sell side. Either one of them gets swept. So let's see how this plays out, guys. Okay, so as you can see, sell side has been swept. And now we want to wait and anticipate a bullish displacement towards the upside, okay? And we're not going to enter before this time. All right, so as you can see here, we actually have displaced, okay? And we've had a market structure shift because we've broke above this short-term high here. And this would be your fair value gap. Okay, and notice how I've not entered yet. Why have I not entered yet? Because we're not in the time macro, right? Time is very important when you enter a trade. So in this instance, the macro begins from 3 a.m. and carries on to 4 a.m. New York time. So if price gives us another entry at 3 a.m., I'm going to look to enter for longs, okay? So let's see if we get that. Okay, and as you can see, price gives us one last entry at 3 a.m. So you'd be long here. Your entry would be at the edge of the fair value gap, and your minimum stop placement would be below the displacement candle's low. Okay, the drawn liquidity for this trade would be these highs up here and potentially even the highs up here. Okay, in this case, I would only be targeting this high here as we have multiple PD arrays in this area. So we have buy side liquidity and we have a fair value gap that is paired with the liquidity level. So I wouldn't be aiming for these highs here. However, you can always take partial profits and leave one contract, leave a runner to see if price can hit these highs here. Me personally, I'm going to be taking off most of my position here. Okay, so let's see how this plays out. This is an easy 1 to 4 risk to reward. You can take some partial profits at this buy side here if you'd like. That is up to you guys. So let's see how that plays out. Okay, so it gives you one last entry here and absolutely smashes. You'll take profit if you would leave partials here. It would smash that. We're getting close to that other buy side level here. So let's see if we hit it. In this case, I would set my stops to break even here as it's already ran through this level. Oh, look at that. Absolutely lovely, guys. And what I've actually noticed on this trade specifically, this is actually a unicorn setup. So this is what I teach inside the live signals room, and this is my exact model that I used to trade, okay? So if you guys don't know what that is, I've actually made a short video on it. It's on my channel. It's called the unicorn model. If you look, I'm sure you'll be able to find it. But pretty much what it is, it's a breaker block paired with a fair value gap, right? So it's two PD arrays, and that's what makes it such high probability. So what it is a low, a high, lower low, and a higher high, okay? So that's a breaker. And this displacement here, once we break through the short-term high, giving us a market structure shift, it leaves behind a fair value gap, right? And that is why it's called a unicorn, because it's paired with the breaker. And usually when price comes into this fair value gap, it tends to fly straight away. It just bounces in there and flies, okay? I just want to make that clear for you guys, just in case if you were interested. But yeah, these are the type of the trades that we do take inside of the live signals room, okay? Anyways, now that you've seen a London session example, let's go over a New York AM silver bullet example. First things first, what you want to do is mark out your obvious swing highs and obvious swing lows. So these are your buy side and sell side liquidity levels. In this instance, as you can see, all of these lows stacked up here, right? This is all low resistance liquidity. So what does that mean? When price comes down and sweeps all these levels, price is most likely going to draw to this level here as well, as it's in close proximity to these sell stops. So in this instance here, I'll be marking out the sell side here, and my buy side liquidity levels would be this high here. Okay, so now that you've marked out both of your buy side and sell side levels, you want to wait for price to sweep either one of them. So let's see how this plays out. Okay, so price has gone and swept sell side liquidity. Now we want to mark out our macro times. So the macro times for this session are from 10 a.m. to 11 a.m. and you don't want to take any trades before this time. Okay, so as you can see, prices within the time. Now we want to anticipate a bullish displacement towards the upside, and then we can enter the value gap and target the highs. So let's see how this plays out. Okay, so this would be your short-term high here. If price decides to break above this, this will create our market structure shift, and then we can enter off a fair value gap. Okay, no entry yet. Okay, boom. All right, we broke above this high here and created a fair value gap. I would put my stop just below the swing low here. The minimum stop placement is below the displacement candle, so you can put it here. However, there's a swing low, so if you want your trade to be safe, I would put it below a swing low, okay? And you would target the highs. So this is easily a 1 to 2 risk to reward ratio. Okay, so let's see how this plays out. Okay, and it looks like price is not actually giving us an entry here. There is another fair value gap here. So what you would do in this case, right? You would get your fib retracement tool out and you would measure from the recent swing low to the recent swing high, and your 50% level is here, okay? So I would set my limit orders in at the 50%, okay? Because this is a big price swing and it's gone without us, right? It hasn't given us an entry, so let's see if we can retrace back to a discount, and then I'll potentially look for longs, okay? So let's see. Okay, and look at that, price taps into the equilibrium, and let's see how this plays out. Okay, so there you go, your TP would have been hit, price runs to your price at liquidity level, and you would take most of your position off here. So now that you've seen the New York AM session example, I'm going to show you the last and final example, which is the PM session. Me personally, if I take a loss in the New York AM session, I will trade the PM session, okay? So let's go over that now. So going into the last example, and what you want to do first is obviously mark out your swing highs and swing lows. Whenever you see equal highs like this within the marketplace, these highs will get taken out eventually, and they're not going to stay like that for very long. And this is because there are traders that trade support and resistance, so they'll be looking at these levels here thinking, okay, this is resistance. Or you get breakout traders, which means once price breaks above this level, they're going to be long in this and they're going to be buying long, right? I'm not doing that. I'm waiting for a opposite reaction and a displacement towards the downside. So traders also jam their stops above these levels thinking, okay, this is very clean resistance. Price is not going to come back here. They feel very safe. What the market's going to do is going to drive up there, take all those retail traders out, stop them out, and then carry on in the other direction. In this instance, I would mark this high out here, and this would be my buy side liquidity level, okay? My sell side liquidity level would be this low here, okay? For this example, we're using the 2-minute chart. You guys can use anywhere from the 1 minute to the 5 minute. That works the best for this strategy specifically. Once you start going over the 5-minute time frame, it gets a bit sloppy, you lose your position. So I would stick to the 5-minute time frame max, right? That's the maximum I'll go. Don't go above the 5 minute. Let's mark out our macro times. So 2 p.m. to 3 p.m. Okay, so as you can see, we are in this time. And now we want to wait and see for one of these levels to get swept. So in this instance, I'm betting that these equal highs are going to get swept. Boom, as you can see, got swept. So retail traders are long in this straight away. Let's see what happens to them. Right, so they get absolutely dumped on. And we actually have 2 fair value gaps, okay? So in this case, I'd be entering off of the lower fair value gap. This is the lowest one. I don't want to miss my entry. And if price tends to trade up here, so be it. In this trade here, I'd be putting my stop just above this candle's high. I wouldn't bother putting it above the swing high, as in that case, it'd be too much risk for me. So this is a nice risk I can tolerate. And I would target the drawn liquidity would be these lows. Also guys, I want to teach you something about drawn liquidity. If you're confused about that term, all it is a meaning where price can go. So if you see a daily or a higher time frame sell side or buy side liquidity level that looks clean to you and you think price can go there, that can be your drawn liquidity. For instance, a fair value gap below 50%, so at discount, that can be a drawn liquidity, or vice versa, fair value gap in a premium, this can also be a drawn liquidity. So the more PD arrays that you have stacked, the stronger your drawn liquidity will be. So let's say you have a fair value gap, sell side, and an order block. That's going to be a very high probable drawn liquidity. Okay, so let's see how this trade plays out. Okay, so price taps us in this fair value gap, and it looks like it's melting straight away. Jesus, okay, and that went to our price target very quickly. Easy 3.6 risk reward trade. I would be all out of my trade here. But yeah guys, that is basically it for the video. If you want to learn more how I take these exact trades, click that link in the description to join my private signals room, where I also teach this exact model. It's only $30 a month, but prices will be going up very soon as the members are making consistent profits every week from our signals. So yeah, make sure to secure that price, and I will see you in the next one.